Secular, are we living in a world of secular stagnation, or are we living in a world of declining productivity growth, right? And if it's the second, then, well, there's not much to do if you think that, you know, it raises the question of what is causing that. Robert Gordon has advanced different reasons. It's not just about technological advance, not producing the results that the first and second industrial revolutions did, the current one due to automation or digital technologies, but it's also due, for example, to having reached the peak in much of the world in terms of what education can contribute to the advancement of individual productivity. And there's the demographics, right? I mean, the demographics obviously play against a higher rate of growth, and not only of growth per se, of productivity growth, because it's related also with the way the participation rate is working in these dynamics. So then, I mean, that doesn't mean that there isn't a case for the United States to build more infrastructure and pay it with debt that is cheap, but it's unlikely going to solve the problem of secular stagnation, if by secular stagnation we mean not just a macroeconomic disequilibrium situation in which the real interest rate is above the negative one that would be necessary, but more of a declining growth issue, which is, I think, what Roberto was, leading for. So the question is, well, what to do about a declining rate of productivity that is not causing, it's not even mutually exclusive with the idea of, having more financial stability, having more fiscal stability, and at the end of the day, what you can say is, if the rate of money expansion is high enough, regardless of the rule, in a world of declining supply side growth, there will be inflation, because the risk is deflation, right? That's the only thing that we want to avoid. Well, at one time there will be inflation if monetary policy is expansionary enough.
Thank you.
Thank you. I have maybe 2 points, a remark, questions. The first on the Jean-Pierre and Hernando's presentation. Second one maybe on Roberto. First, and from different angles, we have a lot of uncertainties, but we have also a lot of certainties. I think the first one is the world population will keep growing dramatically in the next decades. Point two, in a lot of less developed countries, the catching up process is still at the beginning, and then we have still large pockets of poverty in advanced or even in emerging markets. And finally, we have global heating, and the transitions to carbon-free economy will require an enormous amount of investment. So we have a lot of uncertainties, but also we have a lot of certainties. And so what is not clear to me after the two presentations, how to reduce the gap between the enormous amount of savings in the world and the enormous opportunity of investment that we will be confronting in the future. So another way to put it is how to reduce the cost of capital, which is the ex-ante return on equity. What kind of incentive regime could we have to do that? And to some extent, what Jean-Pierre said about monetary policy or fiscal policy is not totally reassuring. He said, and I quote him, that the monetary policy cannot fight uncertainty. And what he said about the level of debt and recurring effects still remain uncertain. And we know that in many countries, the sustainability of public debt now is ensured by the very low level of interest rate. My question maybe on Roberto is, he didn't mention the debate between Robert Gordon and McAfee and the MIT economist on to what extent a digital economy or the IT economy can provide some important input that may ensure more growth in the future. Thanks.
Thanks. So it seems to me this savings glut issue or problem is very much an advanced economy problem. And as somebody has just said, there are lots of developing countries which are starved for funds who would like to invest in the infrastructure, but are wary of raising money in the private markets because they don't want to build in vulnerabilities. I mean, being from South Asia, I can definitely see the need to transfer these savings in a safer way to these economies. And I wonder what is the role that going forward AIIB can play or multilateral institutions can play in channeling these savings into infrastructure.
Thank you very much. I appreciate both sets of presentations, the first session and also the second session, which I think really so nicely covered. I just have a few questions to raise for ourselves to think through about the policy response. So on monetary policy, I think we discussed a lot about the limit. On the fiscal policy, I think we should think through about space. And then structural reforms, I think we should think through overcapacity. Now, on the monetary policy, things we discussed a lot. So let me mention a few words about space on fiscal policy, I think, which has been recently debated and also is a key topic for G20 this year. The question here, I think, we need to think through is how to really define fiscal space, how to assess fiscal space, what variables we should look at, and how should we advise the membership to design and implement. I think once we have a good understanding of how to define fiscal space, we probably can make a good contribution to talk about fiscal policy implementation. Now, structural reform, I think the overcapacity issue probably is worldwide, not only pertaining to China, but also elsewhere. So the question then becomes, what structural reform, what aspects should one look at in a very specific way? Again, this could provide a very concrete advice, suggestions to policymakers. Finally, I would like also to mention we need to think through that globally, policy coordination, what is the scope and the role of policy coordination we should pursue more, because the issues we're facing very complex and could be very structural or long-lasting. Therefore, I think global policy coordination, as the former speaker mentioned, for key players will be very crucial, I think, in the period ahead. Thank you.
Thank you, Massimo. These are very, very interesting questions. So the first one, of course, is, and Roberto dealt with it, is secular stagnation, a supply or demand-driven phenomenon. The truth is we don't know. I personally, I cannot bring myself to be a technology pessimist. I'm a technology optimist. I think there are a lot of possibilities of developing technology supply. There are a lot of needs which are there. I think Pierre mentioned some of them. He didn't talk about health. Aging is going to bring a lot of need for health expenditures, health supply. That is an area of huge technological progress. So my guess is that the Gordon phenomenon is going to be temporary, and that we just have a very long period before this new technology are showing themselves in total factor productivity, but they will show themselves one day or another. And that is why public investment, in a way, has some justification, because it helps push those technologies into fruition, and it also helps sort of attenuate or assuage the kind of anxiety in the population that I mentioned. It's very interesting in UK, for instance, that the health system was at the center of the debate whether they should go out or not of the EU, and that the part of the no vote was motivated by the misled assumption that they would get back a lot of money from the EU, from their contribution to the EU, to finance the health system. So we can see that part of the demand of the population is to get better health system, and if it's negated one way or another, it's going to bring a lot of strong backlash reaction. I fully agree with the first question. If we have a risk management approach, let's say we get it wrong on the origin of secular stagnation, and we stimulate the economy too much, we will have more inflation, and that's what we want. So we'll see it. So I would say there's a sort of asymmetric risk-reward balance in the current environment. If we have too much stimulus, we'll see interest rates go up and inflation go up, and then we can stop, provided we don't do it in a structural way, but in a flexible way. And so, on the other hand, if we don't have enough stimulus and we get it wrong on that side, then we will see a deflation settling in, expectation of inflation continuing downward trends, and we may be stuck in a deflation trap. So this balance of risk-reward is very asymmetric, and for me it pleads for having more stimulative policy. And the markets will tell us whether we are wrong or not. They will tell us in interest rates, and they will tell us in inflation rates. If we are wrong on that, we will see interest rate go up. If we are wrong on monetary policy, we'll see inflation go up. And the fact that we don't, in my view, at the moment, is clearly showing, giving up some signal. Is this an advanced economy problem? That's a very interesting issue. I would say it's an advanced economy problem which is exported to emerging economies. And the reason why it is exported to emerging economies is that emerging economies don't have yet the capacity to issue safe assets. So that part of the emerging economy savings which needs to be invested in safe asset is actually invested in safe asset in advanced economy, and it has to be channeled back, sometimes like the development banks that you mentioned. But this is not a perfect system. I think the perfect system will be a system where emerging economies will be able to issue safe assets and intermediate their own savings between themselves for their own needs. And so here I'm putting a very personal view. What's going on now on the G20 on international debt, which is making debt more fragile, for introducing CACs and conditionality on debt and making it more sensitive, I think it's the wrong direction for emerging economy to go. I think they should try and get some kind of debt or some kind of asset which is safe, which is issued by emerging economy, and that's the ultimate answer to the question that advanced economy are not exporting their problems to emerging.
Roberto.
Yes, thank you very much for the questions. And a very interesting discussion. I guess that what I wanted to stress is the connection between the secular stagnation hypothesis and the implications for economic policy, macroeconomic policy, and particularly fiscal and monetary policy. From some viewpoint, actually, I think that the secular stagnation debate has changed our views on what should be done on the either fiscal side or monetary side very little, and that's what I was trying to stress. I mean, if you did believe, as I do, that there is some justification for, say, increased fiscal expenditure and fiscal infrastructure in the United States, then whether or not there is going to be a permanently lower real interest rate, it's going to change your views. Not too much. Right? Because the main justification for increased fiscal infrastructure expenditure may be just that you believe that there is a shortage of aggregate demand, period, and then all Keynesian reasons actually tell you, this is actually a good way to restart, the economic activity. I guess that the same answer would apply to the debate between digital and IT economy in ensuring growth. I think you don't have to actually have forecast, what that investment in the digital economy, for example, may actually yield in terms of growth, to actually see that whether or not fiscal policy is required in order to stimulate growth or not depends on your view as to what are the market failures that may actually imply suboptimal growth, right? So you believe, and as I actually do, that there is, say, underinvestment in R&D, for example, or in education, then you're going to actually propose that the government, that there be more incentives and government incentives for those activities, regardless or not, actually, you believe that there is secular stagnation or not. In that sense, the debate has actually, to me, so far been irrelevant in terms of the policy prescriptions that one can derive from that question. In terms of monetary policy, finally, I think that it's hard for me to think that monetary policy is actually going to be instrumental at all in dealing with a permanent reduction in real interest rates, because if you I think that most economists would agree that monetary policy has very little power or role, in any case, to try to correct real equilibrium permanent distortions. I mean, I cannot see, for example, how monetary policy can be powerful beyond, say, the horizon in which, say, there may be nominal rigidities, and that horizon cannot be forever. It is true that there are now some theoretical models that assume that prices are fixed forever, but I don't know what to think about those.
Well, from a risk management point of view, it will be better to treat this as a permanent phenomenon. Definitely. I mean, the risk of getting it wrong is huge. So I will go that way. Now, regarding the question about, okay, how do we channel excess savings into investment opportunities in the rest of the world, which are there? Well, I think that I am kind of pessimistic on that regard, because the technology for intermediating these excess savings is not there. Savers want safe assets. These are households, pension funds, insurance companies. On the other side, you have risky projects, risky infrastructure projects probably. And on both sides, you will have to work a lot. You need to pool risks. So do you want more securitization? That I am not sure if you want that, or in which way you want that. On the side of the borrowers or potential borrowers, you need to deal with macro risks, like do you want to have wider current account deficits while you receive these external savings? How do you manage that? How do you deal with currency mismatches that probably will come embedded in the transfers of these savings in the advanced world or in anywhere into these economies?
Thank you. I wanted to address this last point from the perspective of a regional development bank, in this case CAF, and I tend to disagree with the pessimism regarding the possibility of development banks and similar organizations in creating appropriate vehicles that could help bridge the gap between the savings available and the investment requirements, particularly in infrastructure, which is one of CAF's strengths in Latin America. I'm not talking here about bridging the gap between international savings and local requirements. I'm talking about bridging the gap between domestic savings and domestic requirements. And in fact, we're doing a lot of that in Colombia in particular. We have created a special purpose vehicle and have contributed with the Colombian authorities to modify regulatory frameworks so that private pension fund savings can be utilized in a pooled risk mechanism for investing in infrastructure projects in Colombia. We're working on a second type of vehicle that would, how would you call it in English, securitize bank loans to infrastructure projects, thereby helping them match the maturities of their assets and liabilities, at the same time while permitting them to increase their financing to newer or new other infrastructure projects. So I think using the umbrella of MDBs, and this is not just CAF, I think the IFC is doing this, probably the IDB as well in Latin America, using their umbrella, as it were, their capability, their reputation to create some of these imaginative but very sound investment vehicles that can pool risks across many projects and diversify risks. It's beginning to function. We're working on this in Uruguay as well. We're working potentially in Brazil and maybe even in Peru. Thank you.
Although it cannot be only domestic, it has to be cross-border if you look at it from a global perspective, right?
Pardon?
It has to be cross-border. It cannot only be a matching of domestic saving because of the magnitude of the demand and supply side. I mean, that's a little bit a challenge.
We even have excess savings in our own countries
sure.
that are not being productively used. So at least we can begin working with our own resources. The function of a development bank, obviously, is to intermediate resources from the international community for our constituents, which are the developing countries. So we're doing that as a matter of course. This is a more specialized mechanism to optimize the use of domestic savings in a specific country.
I think there was a last question. Yeah. Yes.
Yeah, maybe three comments. I think on development banks, there's an interesting issue regarding, I mean, we want them to play a counter-cyclical role. And on the other hand, I mean, their funding is being subject to a credit rating that depends on their portfolios. And therefore, they end up mimicking a little bit the same pro-cyclical nature that the market is generating, and I think that can be a problem. If you take the case of Colombia, I mean, they want to push their infrastructure agenda with a debt ratio that it's around 45% of GDP, and eventually the credit rating might be at risk, and that will be internalized by these international development banks, and I think that's an important issue if we want them to play a real counter-cyclical or a big supply of funding push role in emerging markets. Also, in the case of Colombia, I think it would be interesting to listen to your views on the whole BIS approach of foreign currency borrowing. Colombia, Chile, a lot of Latin American countries have seen huge real exchange rate changes, and what has been the effect of that on the corporate sector, but it seems that this risk has not materialized to the extent that the BIS highlighted some years ago. And finally, on Jean-Pierre's point, I think a very interesting issue that has not been discussed that much here is, even if we believe active policies are needed, the reality of active policies being implemented in a highly politicized world generates a significant uncertainty that might end up being counterproductive. And we tend to think on a first moment approach without thinking of these second moment effects, maybe counterbalancing to an important extent the effects of active policies. And I thought that was a very important point. I think a great example of that, maybe not related to policies, but I think the muted effect that the decline in the price of oil has had on consumption in the U.S. should make us think of how this whole uncertain environment is basically muting expansionary effects in the current world economy.
Unless there are no sorry.
Well, I'm tempted to reply to Alex on credit ratings and MDBs, but actually I was going to talk about that tomorrow morning in my comments, so I'll pause on that one. I wanted to just make one comment about the previous discussion. I think that apart from the comments of gentlemen from CAF, which I completely agree with, it's interesting on the international side. In a way, it's always struck me as funny that we keep these assets on our balance sheets forever, and really perhaps we need to think of some better technologies for originating infrastructure projects, which is the risky part, and then selling them to other investors, which tends to be the safe part. And I think we've done a little bit of that, but I think there's a lot more one could try to do to try to break up the different risks in infrastructure projects and then harness the international savings as was suggested by earlier. Well, I will respond to one of our exponents. I think there has been some realization of corporate losses in Latin America. I think you can see it on the balance sheet of the Brazilian central bank, and you can see it on the balance sheet of some Colombian companies. It hasn't been a systemic issue, thankfully, but I mean, we have some evidence of losses in some Colombian companies that did issue abroad. So there's definitely been some impact.
I had a quick comment and suggestion following some of what Jean-Pierre said. Jean-Pierre argued very eloquently about the debt anxiety that we seem to have collectively created and suggested that this is something to address. But he didn't go quite as far as suggesting that if we remove this debt anxiety, it would mean that we therefore have a lot more fiscal space than we think we do. And that relates to a point that was made earlier by Lin Jianhai. Should we think about alternative measures of debt sustainability than the ones we have now? In particular, in an environment where central banks have become very large holders of sovereign debt, shouldn't we look at net debt of the consolidated balance sheet of the government and the central bank as a more appropriate measure of the total stock of debt rather than the gross measures that we're looking at? And this is not what the official sector is doing at the moment, but I have some confidence that this is in reality what markets are doing. And that's why markets are very relaxed to lend at negative rates to Japan with a very high stock of debt, because they in fact assume that this debt has been in part monetized and will therefore never have to be repaid. And therefore that, in itself suggests that Japan has a lot more fiscal space than it thinks it does, and argues that Japan, but also probably Europe, are in a far better position to create a meaningful fiscal stimulus than they think they are. I think that's an important point to stress, and that might be a point that is different from emerging economies who don't have the luxury who have not bought sovereign debt to the same degree and who may not have the luxury of fiscal stimulus. So there seems to be an analytical question that I think the IMF and other official institutions could play a great role in doing, and there seems to be a responsibility of advanced economies to respond to that with much more fiscal stimulus than they have so far.
All right, go ahead. I think unless...
a short comment in the context of the last comment that I am sympathetic. Let me point out that another useful way of thinking about debt sustainability is to look not at the debt over, even the net debt over the GDP, but the net debt relative to the tax base and the ability to adjust the tax base. And a major mistake was that in the past we believed that 60% is the threshold that we should view as the relevant one, which is totally wrong. Using this metric, I believe that still both in the US and in Europe there is much more fiscal space than in emerging markets. And the last time that the US approached the present debt that everybody is spending was the end of the Second War, when the debt was net, I believe, about 115%, and everybody believed that the US is entering secular stagnation because of the veterans are returning to the US. And we know that the next 10 years were the opposite. And this, the last point is that our ability to predict the growth of decades is close to zero. So Larry Summers never predicted secular stagnation until we reached 2 years after the crisis. And I'm sure that whenever the growth rate will recover, then smart Larry Summers will come with a different interpretation. So we should take it into account, not treating what we see now as a permanent trend.
If I may add something from we manage money for central banks, I mean, the conflict existing between the central bank as an investor and the central bank as a regulator, it is well known. I mean, in the euro area, actually, it's not just a question of accounting, it's really a question of market behavior. The classical example is the euro crisis, when on one hand you have the ECB going out and buying periphery, and the central banks themselves, who hold a lot of periphery, selling it by changing, for instance, the benchmark against which they allocate sovereign bonds. But I believe that it's a little bit more complicated. You cannot do the accounting trick, because there are regulatory and policy and legal issues here. Most of the return the central banks generate, in many cases, is used to pay the operation of the central bank itself. So if you do an accounting by basically putting the plus and the negative together, automatically you would incur a loss. So I don't think it's so simple to make the central bank put the two things together. But for sure, on the market behavior, it probably would be a little bit easier to make it more consistent. So on that, if there is no, Pierre, the last word.
No. I would not presume to have the last word.
The last word of the session.
Well, first, I think Alessandro made a very interesting, important point. So basically he said, what if aggressive macroeconomic measure would create more anxiety? And so the example of low oil prices and households reacting by withdrawing from consumption is actually a very interesting one. I would say yes, that's a possibility. But I think for policymakers, for those of you who sit in G20, you have to choose what kind of risk you want to take. And now you have a new risk on your table. And the risk is that the international system might be seriously eroded. We have protectionist movement rising up everywhere. After 5 years of no growth in Europe, after whatever happens in inequality in the US. So you want to take the risk of that breaking down, you want to take the risk of having excessive debt, you want to take the risk of missing the target in terms of macro policy. And I think that's when you get to the level of policymakers, this is the kind of question they should be asking themselves when they manage the global system. It's a very risky situation anyway. I think the policymakers still have the choice of what risk they want to take, and obviously there are risks in the path I'm advocating of more aggressive macro policy. But I think those risks, personally, I would feel those risks are lower than the other which are creeping up right now, and that we see appearing in a kind of scary way. And then on China, I think he's absolutely right. We have to rethink about what fiscal space is, both because part of the debt is monetized for likely ever, so we should look at the consolidated balance sheet, and also because the notion of fiscal space is endogenous to growth. A country has a lot of fiscal space if its tax base is increasing fast, or a taxi has or the same country has a very low fiscal space if. So I always thought that the way economists and actuarians look at the fiscal space and the debt sustainability is extremely rudimentary. What I'm pretty sure is that you have to get fiscal framework which ensures sustainability in the long run in almost every state of the world. That doesn't mean you have to get very rigid rule in the short run. So finding the balance between that is, of course, very, very, very difficult. But there's much more to be done, especially, as you said, when part of the debt is monetized. And again, the markets will be the ultimate judge. If the markets keep very low interest rate and no inflation, that tells us that maybe there is some space somewhere.
Just 2 points regarding currency mismatches. One is that in the infrastructure program that we have in Colombia, which is, yes, very ambitious, the government is providing the coverage of the currency mismatches, right? So there are explicit guarantees there. It is not a free lunch. That's one thing. And the other is, yes, we did well. We had a depreciation of the Colombian peso of about 60% last year, and no one went bust. There was, of course, losses. Of course, that's natural, and there were no systemically important events, and the financial system was unhurt by this, which is very different from what we had in the 90s and after the crisis in the 90s. So why that happened? I would say 2 things. In the case of Colombia, at least, we had very strong currency mismatch regulation of financial intermediaries, and we had flexible enough flexibility in the exchange rate so that the private non-financial sector will internalize the currency risk. I think that helped definitely. And I could speak also for, perhaps for Brazil. You had a country with negative growth rates for several years, with a large depreciation, and still the financial system is very solid. So that speaks well about their general financial framework.
Thank you very much. I think we are at the end of the morning, so let me thank the panel for the very useful discussion, and I think we break for lunch.
Maximilian, we're going to meet at the front door of the hotel for a group photo before we go for lunch. Okay.